Now, for the last 4 meetings in September 2020, the Monetary Policy Committee, MPC, has continued to retain the monetary policy rate at 11.5%. But there are mixed projections by analysts that the MPC might or will increase the MPR to 12% in order to sustain the country's inflation rate, which has been on the downward trend for 3 consecutive months. Since the last MPC meeting held in May, there have been a number of key global and domestic developments. On the global front, global growth outlook continues to remain good, reflecting largely activities rebound in the United States and China. However, globally, economic activities continue to face major challenges, including the new coronavirus variant and a heavy human toll in some countries, divergent pace of recovery across countries and sectors, debt burden and slow vaccinations in poor countries. On the domestic scene, the economic recovery rate is still very weak and fragile, as poverty and unemployment rates are still quite high, despite the faster than expected recovery in economic activities experienced in the first half of 2021. As the latest inflation figure released by the NBS remains moderate at 17.75%. Again, FX constraints continue unabated despite favorable prices in the commodities market, as the yields environment continues to rise on the back of inflation and tighter system liquidity, with the implication of insecurity challenges in the country on food supply, inflation, and foreign direct investment into the country. Experts are of the view that these macroeconomic fundamentals, amongst others, will feature in the committee's deliberations and ultimately feed into the decision. I have joining me now via Skype from Lagos is the Chief Executive Officer, Cowry Asset Management Limited, Mr. Johnson Chukwu. Good afternoon, Mr. Chukwu. It's good to see you.
Good afternoon, Tolu. Thank you for having me.
Yes, Mr. Johnson, I will ask with the regular question. What do you think? What are your expectations? A lot of issues, realities are on ground. But what's your overview and what do you think will be in the plate where they're already sitting around that table now? What do you think will be the bone of contention? A lot for them to talk about, really.
Once again, thank you for having me. I believe that the major issues that the Monetary Policy Committee members will be discussing today and tomorrow will be how do we stimulate faster economic growth or economic recovery, and how do we ensure that we maintain price stability. And those two issues, unfortunately, are contradictory in the sense that what the policies that drive one will also actually work against the other. Take, for instance, what you said, that it is possible they want to increase the monetary policy rate by 50 basis points to 12%, and just to fight inflation. But I think, in as much as fighting inflation is important, the most critical factor in the country today is to grow the economy at a faster rate. A growth of 0.51% that we recorded in the first quarter of this year is too fragile. It could actually tip back to a negative. If you consider the fact that agriculture alone, which accounts about 22% of the GDP, had a decrease in its growth rate from about 2.3% to about from about 3.4% to about 2.2%. So, if you take any measure that could lead to further contraction of funding or higher cost of funding in the economy, you could tip the fragile growth we saw back into recession. So my take is that the priority of the Monetary Policy Committee will be to focus on growth. And good thing, even with current monetary policy environment, current rates, we've seen a consistent month-on-month decline in inflation for the past 3 months. We saw inflation plateau at 18.17% in March. And as at the end of June, inflation rate had dropped to 17.75%. So that trend will imply that if we maintain it at current level, the trend could actually subsist. Whereas priority should be to improve the growth of the economy or the economic recovery rate.
That's a good way to start. But I'm looking at all countries like Brazil, Russia, Turkey. Most of them are trying to hike rates, tightening monetary stance just because they want to respond to inflationary pressure. Why do you think Nigeria can't also a little bit tighten up?
Well, in the first place, you have to look at the state of the economy. Some countries have actually entered an expansion phase. The US, for instance, which is the biggest economy in the world, has entered an expansion phase, economic phase. So in effect, we expect that the velocity of money circulation will increase, people consumption will increase, productive activity is increasing at a very fast rate, and they are considering, pulling back on some of the expansionary intervention funds, or stepping on the brake to slow down expansion of economy, particularly expansion of liquidity, so as to slow down inflation rate. That's not the case with Nigeria. Nigeria grew its economy by 0.11% in fourth quarter of last year, and only to grow by 0.51%. Recall, Tolu, that the population is growing above 3%. Recall also that we have an unemployment rate of 33%. And above all, the inflationary pressure we're having today, in as much as you could say that part of it was induced by the expansionary monetary policies or the intervention fund that the central bank injected into the economy to moderate the impact of COVID, the greater part of the inflation we have today is driven by supply bottlenecks, logistic challenges, lower level of productive activities, or particularly as it relates to the agricultural sector. See, what we're witnessing today is that the shortage of agricultural products has led to very high inflation rate, particularly food inflation. Remember that food inflation came at a rate of 21.83% in June, a marginal decrease from about 22.28% in May. So, and if you decompose the inflation rate and take out food inflation, the core inflation is just about 13%. So it is driven by the fact that we have allowed the level of insecurity in the country get to the level that a lot of people who have been in farming zones are displaced and living in IDP, internally displaced people's camps. So the level of food production has declined, and that's the major contributor to the inflation. So if you push for further contraction in credit, you are not going to achieve anything. The key thing is to address the structural weakness we have in the economy, so as to restore productive activities and bring enough food into the economy and bring down food inflation, which will drive down inflation.
Another thing that analysts are talking about is the fact that governments should not be in a hurry, particularly at this time, to look at fuel subsidy issues. That's taking out subsidy at this time, because that would also tell on inflation. I don't know how that comes to you.
Yes, it will. It's a complex issue, and I'll tell you why I say it's a complex issue. The president has said, you see, anything we say about the fuel subsidy issue is just academic, because the president has said in his interview that he's not going to encourage taking out fuel subsidy because he doesn't want to inflict more pains on Nigeria. And he said in that broadcast that he believes that people will go on there will be civil unrest if the price of fuel is increased. So everything we say now is academic. But if we have to even play the academic card, you see, part of the challenge we have is that in the economy is the structural bottlenecks or structural weaknesses. You can't address those structural weaknesses if you are spending government revenue on consumption that is not stimulating local production, which is what the subsidy is doing. So we have to decide at some point in time that we take the pain and then live to enjoy the benefit of a more efficient economy. And that efficiency will come from if we build infrastructure, improve power supply, improve the road network, improve logistics supply at the seaport so that goods can come in quickly and be cleared, improve the level of insecurity. These things will require funding. If you spend 3 trillion naira, which is about twice what we spend on infrastructure, if we spend 3 trillion naira on fuel subsidy, which is twice what we spend on infrastructure, I wouldn't know when we'll be in a position to have a world-class, a first-class infrastructure that will support productive activities, that will lead us to have a very low rate of inflation, because first world economies, well-managed economies are having inflation rates of 2-3%. South Africa got to 5%, and they were shouting as if the health had gotten loose. But here, we live with inflation that are almost 30-20%, and it's like a normality for us.
Let's talk about Forex. We've always talked about this, but we see what's happening to the Naira. I think at the moment, the parallel market is trading at over 500 Naira, about 503 Naira. We also see that at the stock exchange, we've seen a little bit of rebound last week, but it's been up and down. Now, I think there will be discussions also around this at the MPC meeting, because all of this will be looked at one after the other. Now, what do you think is responsible for all of this that we still grapple with? I mean, FX and confidence at the NSE.
Okay, let's start with FX, and it's also related to what's happening in the equities market or in the stock market. In the first place, you realize that foreign portfolio investors have stopped coming to the economy or have almost withdrawn from the economy. A lot of them want to exit the economy. So what is happening is that at a regular intervals, central bank avails banks funding foreign exchange to meet the demands of their foreign portfolio investors who want to exit the economy. You have foreign investors who are taking their money in form of dividend, or who have sold the proceeds, who have sold their investment and want to exit. So that is putting pressure on the reserve we have. Added to that fact is the fact that we're having a negative balance of trade, which means the total value of our export is less than the total value of our imports. So once you have a negative balance of trade, it simply means you have to pay for that negative or that difference from your reserve. And these things are depleting the reserve. So you have outflow from foreign portfolio investors. Then the fact that foreign portfolio investors are not coming to the economy and are not investing in the capital market simply means one major component of capital inflow into the capital market has dried up. So you are left with either retail investors or local institutional investors like the PFAs. And at such point, the demand for stocks have actually gone below what it used to be, because a key component of those who are buying those stocks are not in the market. So that's why you are seeing that fluctuation. So what's happening is that whenever the price moves up marginally, people want to take profit because the level of confidence in the market is not as strong as it used to be when we have foreign portfolio investors in the economy. So you have to look at those facts. Another factor is contributing to the fluctuation in the capital market is the turnaround in this interest rate environment. We saw last year interest rate was in the neighborhood of 1%, 2% for 364-day treasury bills. Today, we have seen rates touch as high as 9.75% before it started coming down. And because rates have gone up, investors would have looked at what is the dividend yield. I checked the report that said the average dividend yield on Nigerian equity instruments is about 5.3%. At the point when you can buy treasury bills at 9% or 8%, then you would want to go for that instrument that gives you higher yield. And that's why we say that when interest rates go up, investors underweight their portfolios in equities and overweight them in fixed income instruments. So those are the things that are playing out in the Nigerian economy, both in the FX market, in the equities market.
Almost wrapping up, exports is what many talk about when we look at improving FX and helping address this challenge. We also see this 50 billion naira export expansion fund being provided by the government through the ESP, through the NEPC, trying to improve. How well, Mr. Chukwu, how well are we doing with improving exports, so we can even get some more FX aside selling of crude?
So the answer is that we're not doing well. Let me tell you some basic facts that we need to recognize when you want to encourage exports. You must have a supportive infrastructural base that will make it possible for people to produce goods efficiently at costs that are comparative to what obtains elsewhere in the world. Today, we have one of the weakest infrastructure supply in the world. We don't have the road network, that's the transport infrastructure. We don't have the power infrastructure. And we have also dealt with insecurity. So what happens is that no matter the amount of money you give to able to export goods, they are not able to improve the value of what they want to export. And if they try to improve the value of what they want to export, what they call benefication, they're going to produce at costs that are higher than what you will produce elsewhere. So they can't compete in international markets. So we need to address those heavy lift, what you call the heavy lifting, that will create an economic environment, an infrastructure environment that will support productive activity in the economy. And that's when we can actually grow the export markets. So otherwise, you give funds to people who are exporting basic raw materials. basic input materials, and you don't get so much value from exporting raw materials or basic items. You get value from exporting goods that have value added. And we can't have value added in the economic environment where the cost of production is far more expensive than what obtains elsewhere in the world.
Well, it's a good way to leave it. One more word for the MPC guys, Mr. Chukwu. What would you tell them if you were to just send them a message now on all their considerations?
I would tell them to focus on restoring economic growth, improving the rate at which the economy is growing so that we can create employment and reduce the social upheaval that high level of unemployment is creating in this economy, which includes the insecurity we're dealing with.
Mr. Johnson Chukwu, it's always a pleasure having you. Thank you very much for spending your Monday afternoon with us. We know you're a very busy person, but we really appreciate this.
Thank you for having me.